CoreWeave stock is crashing, and I think that's making a lot of investors fearful about this company, and they're wondering and panicking if they should sell the stock and making rash decisions. Whenever this happens, I like to dig deeper and do more research so I can make a more informed decision, and that's what I'll do for you all here that are interested in CoreWeave stock. We'll dig deeper, we'll do more research so we can make a more informed decision rather than making a panicked or emotional decision because of the price movement the market's showing us.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So CoreWeave is one of those businesses right now where its revenue depends on how much supply it can increase. Demand for the company's products exceeds, and I'll quote management, they said it far exceeds supply. So that means the more supply they can add, the more revenue they will generate. And given that, they expanded their active power footprint, which allows them to create more computing power to sell to their customers by 120 megawatts sequentially. They now have 590 megawatts while growing their contracted power capacity over 600 megawatts to 2.9 gigawatts. So they added the potential of more capacity coming online. And in the previous quarter, they added meaningful capacity going from 470 megawatts to 590, adding roughly 25% capacity in one quarter alone, which allowed the company to generate significant increases in revenue, which increased by over 125% from the same quarter the prior year. So in the third quarter, they executed large-scale compute contracts with many of their largest customers, including Meta Platforms and OpenAI. These large hyperscalers have told investors they want to add a lot more capacity, and they're doing a lot of that internally with Meta Platforms. That is, OpenAI is contracting for service, and they're just contracting with several partners and just adding as much capacity they can find. Their businesses also have demand that exceeds capacity, and so they are also increasing capacity. The whole ecosystem for artificial intelligence is supply constrained. Nearly every part of the ecosystem has more demand than it has supply. And so you might be wondering, if that's the case, why are these stocks crashing over the last few weeks? And in CoreWeave's case, it's down roughly 50% in the last month alone. And the primary reason is that investors are fearful of what the situation will be 12 months from now or 24 months from now. Right now, they might be seeing that demand exceeds supply, but nearly all of these companies are spending aggressively to add a lot more supply, and investors are worried that there's too much supply coming online. And they're worried that it's going to be in a situation like, I've talked a lot about how I dislike car companies because the car industry is in the situation that investors are afraid about that the artificial intelligence industry will be in, which is in a situation that has far too much supply to serve demand for market participants, right? If you look at the data in terms of the overall manufacturing capacity for automobiles worldwide, and it differs based on the source you look at, but the estimates go from 100 million units to 120 million units of manufacturing capacity for automobiles worldwide. So that means if automobile manufacturers were producing at normal levels, near full capacity, not 100% capacity, but near full capacity, that they can produce up to 120 million units annually. But demand from automobile purchasers is roughly 85 million to 95 million. And so you could see there's a lot more capacity than there is demand in the automotive industry. And this is especially true if you look at more specific categories like the electric vehicle industry, where supply in that category far exceeds demand in that category by a lot more than what the overall market indicates. And in 2020 and 2021, every investor was so excited about the electric vehicle industry because they thought it was going to be the future, and they jumped into a lot of these unprofitable and speculative investments that are now down 90, 95, 99% off their highs, and some of those companies went bankrupt because the early excitement and the early forecast of what that industry could be was far in excess of what it actually turned out to be. But unlike the AI industry, I identified the EV industry as one that was not very good for investors. And I warned investors about the EV industry multiple times throughout these several years not to get overexcited about that industry because the structural position of that industry was not attractive. But for artificial intelligence, it's a lot different because the fundamental performance improvements for every single worker has the benefits that exceed the cost of delivering that technology. And so there is a fundamental improvement in employee performance, in business performance. And so businesses that are spending money on artificial intelligence are seeing the benefits of those investments. And those investments continue to gain in value as inflation continues to increase, as the cost of labor continues to increase. And so it allows businesses to generate more with fewer employees or to generate the same amount of productivity with fewer employees. And so it's giving that business a boost in productivity, a boost in profitability, a boost in competitive advantage to justify these investments in artificial intelligence. And we're still in the early stages of that. There's still room to continue benefiting from these investments. While I still agree that there is a risk that there might be overinvestment in this category, but I think those risks are relatively minimal because of all the applications where this computing power can go. Right now, we're just seeing the benefits in terms of large language models mostly. But in 3 years' time, in 5 years' time, in 7 years' time, we're going to start to see the benefits of artificial intelligence in real world technology, in things like robotics, where food delivery companies like Uber are partnering with robotics providers like Serve Robotics to deliver food to your home at a significantly lower cost. And then we have companies like Tesla and other car manufacturers that are investing in driverless car technology, which can lower the cost of transportation and lower the cost of delivering products and transporting products around the world. And so you're seeing the benefits of this technology in improved productivity. And so there's an underlying benefit here that's driving growth. CoreWeave specifically is adding new customers, and in the most recent quarter, they grew their relationship with the leading hyperscaler, marking the sixth contract with this customer to date. And when you look at valuation, now I've shared with you the valuation on my proprietary DCF, where I calculated an intrinsic value per share of 123 versus a current market price of 74, suggesting that this stock is undervalued at these prices. But if you go to fiscal.ai, which is my preferred data provider, and you look at CoreWeave's forward price to operating cash flow, it's trading at a ridiculously cheap value at 6.4. But this valuation can be misleading because the large bulk of CoreWeave's spending is going in capital expenditures, which is not included in operating cash flow. That's included in cash flow from investing activities. And so it makes its operating cash flow appear much stronger. Of course, the company will experience a higher depreciation expense as a result of all those capital expenditures, and the company will need to continue spending significant sums of money, tens of billions of dollars annually, in order to generate revenue growth because it's at the limit of its capacity right now, which means it cannot generate very much revenue growth with its existing capacity. It needs to spend billions of dollars more in order to generate more revenue. And that's really what's concerning investors, is the company is spending too much to generate revenue. It's not an asset-light business model. It's the opposite of an asset-light business model. And so it's operating in an industry where demand is highly questionable 24 months from now, even though it's very certain over the next 12 months because they've already got the contracted orders. But 24 months from now, 36 months from now, it's a highly uncertain environment for demand for its services. So that's an added layer of risk on top of the risk of operating a business that has such large capital intensity. It's always a risk when your business requires large capital expenditures every year to support the growth. And so it's understandable why investors are shying away from CoreWeave stock. But I think overall, the risk versus reward is worthwhile. And I have CoreWeave stock rated as a buy. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.